Welcome to the Deep Dive. Today, we're digging into the latest updates from your pension advisor, trying to make sense of recent market news.
Exactly. Think of it as us pulling out the key bits, the things that really matter for your financial landscape without getting lost in all the noise.
Our goal is just to highlight what's important for you.
Precisely. Focusing on what might actually affect your financial well-being.
Okay, so let's jump right in. Big news seems to be this U.S.-China trade situation. A 90-day pause.
That's right. They've agreed to, well, hold off on hitting each other with new tariffs for a bit.
And the market seemed to like that quite a bit.
Oh, definitely. The S&P 500, for instance, it jumped 5.3% just in that week.
Wow.
Yeah, actually pushed it above where it started the year. Shows you how much appetite there is for, some stability there.
Okay, that sounds positive overall. But I gather for sterling investors, maybe less so because of the dollar.
That's a really good point. Yeah, the U.S. dollar weakened a bit. So when you convert those dollar gains back into sterling.
They shrink a little.
Exactly. It dampens the effect somewhat. It's a reminder, really, of how currencies play into everything.
Right. And the tariff levels themselves during this pause, are they significant cuts?
They are, actually. The U.S. reportedly dropped some tariffs from like 145% down to 30%.
That's huge.
And China, similarly, from around 125% down to 10%. So yes, substantial reductions for this period.
Makes you wonder if this is, a real shift. But I guess nobody knows if these levels will stick long term.
Precisely. It's a pause, a truce, maybe, but the underlying issues, they haven't vanished.
Okay.
And we saw positive reactions elsewhere, too, right? China's Shanghai Composite was up, Hong Kong's Hang Seng, too.
Right. Okay. Now, shifting gears a bit, Moody's, they downgraded U.S. Treasuries.
Yeah, another one. They took the U.S. down from the top AAA rating to AA1.
And that follows Fitch and S&P doing similar things earlier.
Uh-huh. The reasons they cited, well, it's the familiar concerns rising U.S. federal debt and, crucially, the growing cost of actually paying the interest on that debt.
So how did the markets react to that news? Was it dramatic?
It was. Interesting. The U.S. dollar dipped. Stock futures fell slightly initially, but Treasury yields themselves, pretty stable.
Which seems a bit odd. You'd think a downgrade would push yields up.
You might think so, but it suggests that despite the downgrade, there's still, massive global demand for U.S. Treasuries. They're still seen as a relative safe haven, basically.
Okay, interesting. Let's hop over to Europe. Did the trade truce give them a lift too?
It certainly seemed to. European markets generally had a good week. The FTSE 100 in the UK was up 1.5%? And the FTSE 250, which is more UK-focused, did even better, up over 2%. So generally positive mood there, too.
Good to see. And oil. I saw Brent crude bounce back a bit.
It did, yeah. Back up towards $65 a barrel, though, there was some volatility mixed in there.
The U.S.-Iran nuclear deal rumors.
Exactly. Things like that geopolitical stuff, it can really swing the price around quite quickly in the oil markets.
Always something going on there.
Yeah.
Okay, finally, let's just quickly touch on some economic numbers. UK GDP.
Actually, a positive surprise there. Growth came in a bit better than expected for March, 0.2%.
Okay.
And that helped the first quarter figure, too, which was up 0.7%. So some resilience, maybe.
And U.S. inflation.
Came in slightly under expectations, which, always gets people thinking about what the Fed might do next.
Right. But Japan saw a contraction.
It did, yeah, a small contraction, 0.2% in Q1. So it just highlights, doesn't it, that the global economic picture is still pretty mixed. Different regions facing different things.
So if we sort of pull all this together, it feels like, okay, easing trade tensions gave markets a boost, which is good. But then you've got this U.S. Treasury downgrade lingering as a concern.
A definite counterpoint, yeah.
Europe seems okay, broadly speaking. And the economic data is just, well, a bit all over the place, depending where you live.
That sums it up pretty well. It's complex, it's interconnected. You really do need to keep an eye on all these different strands.
Okay, so maybe here's a final thought for you to take away. With all these moving parts, the trade truce, the U.S. debt rating, the different economic signals, how might these shifts, collectively start to shape your own long-term financial thinking?
Yeah, what questions does this raise for you about maybe global economic stability or how your own investments are positioned for whatever comes next?
Definitely something worth mulling